about the mining sector right now?
Well, welcome everyone, and thank you for coming along to the one-to-one conference. As Leo said, it's not a great time in Hong Kong, but we're all getting on with it. I guess in terms of the mining sector, APAC Resources is a specialist global resources investor. So that's what we do. That's the only thing we pretend to know a little bit about. And when we look at a lot of the macro data that's coming through, I think a lot of the leading economic indicators are probably still pointing downwards at the moment. I think in recent months we've seen global trade contracting. I think global manufacturing PMIs have just gone below 50. I think if you look at the leading indicators like new orders in the PMIs, I think that's gone down to 47. So we're still a little bit nervous. Things like the trade war, we've been going for 18 months now. It doesn't really seem to have a resolution in sight. I think if we look at this stage one truce, it looks like more of a non-escalation rather than any sort of deal. So we're positioned a little bit defensively because we think things probably can get a little bit worse before they hopefully get better.
And how are you positioning yourself defensively for this?
I guess in terms of the portfolio I run at APAC, it's about 50% gold. In these sorts of macro environments, gold generally tends to do quite well, especially when you've got, I think, around $18 trillion of negative yielding government debt going around the world. The opportunity costs for owning gold, and as a result, sort of gold mining equities as well is pretty low here. We've got about 20% cash, and then 30% of things like industrial metals, which have been pretty difficult the last few months.
And what sort of companies, what size of companies are you going for? Are you looking at some of the diversified miners are doing pretty well at the moment, and they've...
Yeah, I mean, for a lot of investors, I think, if you're a little bit nervous with the world, it's hard to go past some of the big producing companies. If you look at the diversified space, the major diversifieds, they're trading on 9-10% free cash flow yields. You might find 6-7% dividend yields. They've really done the right things in terms of cleaning up balance sheets. They've cut capex over the last few years as well. I think capex for that space is down about half from the 2013 peak. So they're in really good shape. So it's still giving you leverage if things move up, but at the same time they're quite defensive. So we've moved generally more into the producing space. And you can see that with a lot of other investors as well. We've had this rally in the gold price. We're up to $1,500 an ounce here. There's an index of mining companies that are up 70% in the last 4 months, and actually the developers are flat. The investors just aren't really there for the developers at the moment. That's not always going to be the case, and there will be a time when I think investors will change, and maybe that's going to be prompted by maybe a wave of M&A because you've got this really big valuation disparity. And we're looking to make that move when it happens, but at the moment it's mostly in the producers and the near-term developers.
Greg, from the banking point of view, how's the landscape looking?
Well, we would agree with a lot of what John said. It's still a time, I think, to be relatively cautious, although the way I look at it and trying to look at it over sort of a very long cycle, having covered the mining sector for about 25 years, I've seen a few cycles, and some of the things that we are seeing going on today remind me a lot of what we saw in the late 90s, which was sort of the beginning of quite a long bear market for the sector, and ultimately resulted in one of the great bull markets for the sector. For example, if you look at capital raising in the equity markets in Canada, and I'm with CIBC, so that's a market that we focus on quite intensely. Last year, 2018, was the lowest level of new equity issuance in the Canadian market in 20 years. If you look at other measures, when I was down at Diggers and Dealers last year, it was being pointed out to me that at the Kalgoorlie School of Mines, they had the lowest level of enrollment for engineers that they had experienced in years. So when you kind of think of what drives the market, and it's ultimately tends to be supply and demand, we're seeing the elements that set up for a contraction, or certainly a slowdown in supply. Capital's unavailable, people are unavailable, investor interest, I'd still say is either on specific names, or it's fairly apathetic still. So you're seeing a restriction on the things that grow supply. We have an environment globally in the economy where demand growth has certainly slowed down, but if you look at fundamentals for some key commodities, and pick copper, for example, people are still very bullish on copper long term. They're still using $3 plus as their long-term forecast. So the outlook is very good, but if you look at where copper equities are trading, they've all traded down between 40 to 60% over the last 12 months. They're trading at around 0.5, 0.6 times NAV for sort of the large major producers. Some companies are trading at 0.1, 0.2 times. So you see an environment where there's not a lot of capital available. People still aren't really investing in the sector. There's not a lot of growth in supply. And eventually we'll see a pickup in demand. And I think longer term, we're potentially setting ourselves up for another bull run. And kind of that's how I sort of think of it from the perspective of kind of looking at a 20-year time frame. At the bank, we continue to lend to the sector, very comfortable with our loan book.
What's your typical loan?
Well, it can vary anywhere from $50 to $500 million, depending on the client. So I think our loan book to the sector is probably close to $10 billion. It would be one of our largest exposures at the bank in terms of a sector.
Is there a particular commodity you would favor at the moment? Obviously, gold has been mentioned.
Well, gold has clearly done well. Again, if you were asking me 2 years ago, gold was really in the doldrums. Again, companies were trading at decade-year lows in terms of valuations. Stocks like the Barracks of the world were trading barely at NAV or even at a discount. So we've seen a good recovery in gold. And I think the other thing that's happened, which is positive for the sector, is there's just a lot more focus on capital discipline. I think the managements of companies are, they're just doing a better job in managing their businesses. They're more focused on ensuring they're getting the right returns. They're very careful with their capital. I think a bit of it's a reflection that it's tough to get the capital from the market. But certainly, the gold sector, we feel very comfortable with. Although, $1,500 gold, I think the long-term gold price forecast consensus is still a little north of $1,300. And I think if I were, telling people where we would see value in the market, I think I'd focus more in the base metal sector than the gold sector right now.
Interesting. If we could jump to Peter, just because Greg mentioned about capital raising, I think John mentioned as well. You're our mining representative on the panel here. Capital raising, how's that going for you?
Well, generally in the market, it's the lifeblood of the juniors is the retail market, and the retail's been very difficult over the last several years, and much of that's driven by the interest in the cannabis or marijuana stocks. Last year, we saw approximately $4 billion raised for marijuana stocks on the Canadian exchanges, and just over $200 million for mining stocks. The top 9 of the top 10 companies on the TSXV were marijuana stocks. So that really drew out all of the money that was available for the junior miners in Canada, and that's had a significant impact on the ability to raise money for most juniors. That has started to change. We've seen those marijuana stocks that carried so much market cap now decrease in value by about half, and driven by the precious metal side, we started to see an inflow of money back into the junior industry. I'm seeing sort of daily announcements of financings in Canada for precious metal stocks again, which would have been every couple of weeks last year. So there has been a shift, and I think that will continue. For us, we have raised somewhere in the vicinity of $30 million over the last 2 years for our gold projects in Mongolia, but it's been a struggle, partially driven by that retail side. But we've had to work a lot harder for those dollars. We found that much of that money is coming out of ultra-high net worth or family offices, both here in Asia and in Eastern Canada. And more recently, we announced a deal with the European Bank of Reconstruction and Development that will fund our project in Mongolia with a convertible loan. So a little bit less traditional type sources of investment than we might have experienced a decade ago.
Absolutely. But now that you mentioned now that the cannabis stocks have been falling, you would expect some of that money to come back into mining.
Absolutely. We are seeing that. I get a daily update from Canaccord, who's one of the most active in the industry, and you'll see 10 or 12 financing announced pretty much every day for these junior companies in the TSX and TSXV, where, as I said, a couple of years ago, you're lucky to see one financing per week. So the money is coming back in.
Absolutely. And Jorge, Peter mentioned, family offices in Asia. You're sort of in this space in a way. Well, how are you feeling about the opportunities of this?
Yeah, so for us it was an interesting summer. We a couple of years ago we had looked at the environment of where commodity prices were, and we looked at silver as one that was really not loved or appreciated. So we privately invested in 2 properties in partnership with Mag Silver, which is one of the mid-tier producers. And with our own money, kept that project, in good standing, sort of conserving capital, doing a little bit of work. And then this summer, I spent the summer in Vancouver, and when gold started to have a move, then all of a sudden we started seeing a lot of interest to finance, particularly silver equities, because there's a very low supply of silver equity, sorry. And when gold took that move from 1350 to 1500, silver didn't really move at first. And then Canadian investors intuitively know that ratio eventually narrows down. So we decided this is the right moment to take the company public. So we did a deal with a shell. But the summer was a very interesting time because Canadians, and I know there's a lot of you here, typically hibernate during the summer, so it's not a place where they do a lot of work. But I think because the windows to raise money from the retail market are so small, people cancel their vacations, and you could see them really upset taking a meeting as late as 2 p.m., which I don't think I've ever seen that before. And a lot of financings in the silver space got done in July and August. Amazing, like companies that couldn't raise 300 grand, there were $7 million. The other thing that was really interesting was as you go around Vancouver and Toronto, everybody says, oh yeah, I can introduce you to Eric Sprott. And I think essentially Eric Sprott has gone on a funding spree of a number of gold and silver companies. But very much resonate with your comment. The retail market's still challenging, and at the end of the day, the Canadian retail market is the lifeblood of these stocks. And but in terms of where the market's at, I just wanted to resonate with John's comment on the liquid side of our portfolio. I think the most interesting space to look at right now is the mid-tier gold producers. If you look at the charts, when gold was at 1350, the equity valuations were very similar to where they're at now, with gold a good $150 to $200 higher than they were at the time. And I think if you guys are looking at where to put the money now, I think that's where it makes the most sense. Because the fact is, we're now into maybe 2 full quarters of strong gold price, and starting actually this month, the mid-tiers start publishing their quarter results, and you wanna believe that they're going to be strong. And one thing that if you follow the market, if you look at the register of most of these mining companies, it's mostly now ETFs and quant funds. And those quant funds are basically just looking for headlines. So as soon as they start seeing, the headline of, stronger EBITDA, cost reductions, et cetera, that's when I think the money will flow into the index. So I think in terms of risk reward, that GDXJ and GDX indices are extremely attractive right now for the next couple of quarters. And probably what will happen is they'll have great 2 quarters, and then I think the danger is then if gold remains strong, then the mining costs become a little bit higher. But for like say at that point, maybe you rotate that money back into what you were saying, the developers and maybe the junior miners. But it's a very tough environment. I got to see it firsthand during my trips in the last couple of months. But in terms of precious metals, things are lining really well in terms of macro, in terms of what you were saying about the cannabis drying out. And then I think long-term copper seems extremely attractive. And then copper equities, we're spending a little bit of time looking to see what's there that we could, not expecting that they will do well in the next little bit, but I think, like say, over the next couple of years, it's extremely attractive.
Absolutely. David, let's bring you in now. Can you tell us a little bit about Fosun Resources Group as an intro as well?
Yeah, we actually is an investment company. We have asset under management roughly $4 billion. So we control 2 listed companies, one in Hong Kong, one in Shanghai Stock Exchange. Then we had a large secondary market portfolios, mainly through our insurance company, but we're managing their money. So roughly we 4 to 5 billion under management. But the group is much larger. So the group is actually 80 billion, AUM. So we are mainly responsible for resource investment for the group.
Sure. And how's your feeling about the market? I mean, it must be a good time to be a buyer.
I'll put this way, I would say it's quiet right now. And it's not a very favorable sector. The investor is, investors are looking at, honestly speaking, because we have both family office and institutional investor. So after things 2011, the commodity price actually is in overall declining trend. So it's quite bumpy for most investors, and they may suffer some losses. Of course, maybe some has some returns, but right now I will say still quiet. But not the bottom, but I will say quiet. And most investors, they are more prudent towards their investment.
Which commodities would you be looking for, or are you looking for? Favor?
I would say we are more positive on non-ferrous towards ferrous, and we actually look at more metals tied to new economics. Yeah, that's our stance,
So you already have investments in lithium companies you mentioned.
Yeah, we had some investment. Yeah.
And are you looking across the wider battery metals into cobalt, nickel?
Yeah, we look at cobalt, nickel, graphite, even copper. Yeah.
Excellent. Let's talk a little bit more about gold. There seems to be let's keep it on the favourable things. The gold price, Greg, you mentioned that you thought it was going to probably go back down towards sort of 1,300.
No, I was just commenting that if you look at the analyst consensus, I think it's still it's a little north of 1,300. I think for the next year, I think people are projecting an average around 1,400. Frankly, I'm pretty positive on gold still. If you think of a world where we're going to continue to see very low interest rates, potentially more negative interest rates, whether we'll see that phenomenon happen in the United States, that would be quite a dramatic thing. So in that environment, I think gold will probably continue to perform pretty well. The other thing I say about gold is, frankly, people have been asking me about where the price of gold's going to be going for years, and I've kind of concluded I don't really know, and nobody does. But I think if you look at some of the things that you typically expect to be positive for gold, you've got a low interest rate environment, which everyone anticipates is going to continue and may even go lower. You certainly have a lot of volatility in the market. There's been some sort of positive developments around trade and maybe a Brexit deal, but look, I think we should assume we're going to continue to live in a very volatile world where assets that have some safety and security like gold will continue to do well. So I think the bias on gold is frankly still probably more towards the upside than the downside. But if you look at the analyst consensus, so that's the average of the CIBC, the Goldman, the RBC, everybody, it's a little north of $1,300 long term, which is obviously less than the current spot price.
But it's interesting when you talk about the average price, the average consensus, is that some of those analysts are saying it's going to go down to sort of 1,100 or something, and some people are saying it's going to go to 1,900. So actually, an average price is sort of, it's almost meaningless to talk about the averages in this environment where nobody seems to have any real consensus.
Well, I think 1,900 would definitely be an outlier. There might be someone out there with that. I think, frankly, most of the analysts are around kind of $1,300 to $1,400 long term. But again, if you look at gold prices in different currencies, I was at Diggers and Dealers in Kalgoorlie in August, and we were at record gold prices in Australian dollars. Yeah. And while everyone was in a pretty buoyant mood about the sector, talking to CEOs, they said, "This is great. We're really happy. We're making lots of money. Our share price is doing very well." But we've all been here before. We've seen environment where gold price has been very high, everything looks good, and the market can turn very quickly, so we need to continue to be pretty careful about what we do.
And going forward, what should companies be doing? I mean, we talked about capital discipline. Continued capital discipline, or is this now the time to start looking to invest for the future? John, what would you like to see your companies doing?
Look, I think a lot of companies have actually done a really good job over the last sort of 5 or 6 years. I think 2011 probably was the peak in terms of prolificacy, just in terms of spending and growth for growth's sake. And there was really a sea change after that, and a lot of mining companies have really sort of cut back. They've really gone back to mining 101 in terms of some of the basics. They've been a lot more shareholder friendly in terms of controlling equity issues. They've managed to pay down quite a lot of debt. For where we are in the cycle, the diversifieds, for example, are less than 0.5 times net debt to EBITDA, which is very low for this point in the cycle. So I think a lot of the companies have done those things well, but we're now getting to the point where maybe reserve lives for some of these companies is starting to get a little bit short. And given this divergence in the performance of the producers and the developers, I think taking a corporate view and you're able to take this sort of 5, 10, 20-year view, it's probably getting to the point where you can start to look at some of these better quality but actually undervalued development projects, and now's probably a good time to be looking at those things.
But you have to be pretty confident. You have to have, I was going to say balls, but that's probably not the right word. You have to be pretty confident that the things are going to get better to jump in there.
Well, I think things are always going to get better. It just depends on how long you give it. And all of us, it's impossible to get the timing exactly right. I think for corporates where you're building companies for the next 20 years, you can be a year early, 2 years, 3 years early. On the investment side, if we get stuck with sort of 2 or 3 bad quarters, it hurts a lot more. But I think now probably is a good time, and there's companies out there. Things like, for example, we're invested in a company called Adventus, has a 5% copper open pit in Ecuador. You don't see those very often. We caught up with Peter at Erdeen's, and they've got a fantastic gold development project in Mongolia. There's a lot of these sorts of development projects which just haven't performed because investors just aren't looking for these sorts of projects at the moment. But for corporates, who really need to rebuild those reserve lives and those project pipelines, I think now's a good time.
So David, but you were saying that you're a bit cautious at the moment, but sounds like it's the time to be buying things. How do you persuade your investors that this is now the time when they're probably saying, oh, you should be a bit cautious?
I would say first we look at what is the cycle right now. What is status of cycle? We will say, so it's personal view, okay, not group view. It's between the mid cycle and the bottom. Then, because we are investment company, we will normally like to diversify our bets. So what we do is, because we have a listed company will also have secondary market investment. So we look at what type of investment we want, whether it's strategic or it's purely financial. So, but anyway, it's down to the valuation management, like was said just now, is capital discipline. So we view it as part of the trust the management can earn for their shareholders. So it's really the thing they should balance for the company and the shareholders. It's, if they think it's good for the company and the shareholder, they should do that. And the time will prove. So that what we really view the capital discipline. So, and so go back to the how we're going to propose the investment. So we look at different commodities. So we will probably choose one or two among each market, whether in terms of the valuation, cost competitiveness, some core matrix, sorry, and whether they will bring synergy to the group or not is purely financial investment. So that kind of, and also we will look at the market momentum. So we really, I think we, put it this way, we had a pretty handsome return in early 2015 when everybody rushed out of the Russian market, but we actually jumped in. So, right. so that's just a case we share with everyone. So that's what we did for the investment, because we are the group is diversified. So we have to convince the board, whether it's attractively to make the investment in the sector, in mining sector, compared to other sectors.
But it sounds like, I was going to say that it must be quite hard for you to be a contrarian investor when, you might want to jump into a sector when it's unfavored. But actually, it sounds like with your Russian investments that you were able to do that.
We like to have some kind of independent thinking. No, we don't like to follow the market, but sometimes we miss opportunities. But still, and after, because we forced into the mining sector since 2002, so, and time to time we think for mining investment, you really need to think a bit long term. Otherwise, I don't think you will have, especially if really a cyclical industry. You don't know what's the bottom, what's the peak. So you better to think long term and better focus on the cost competitiveness, because you cannot control the price. So that's some lessons we learn. Yeah.
Absolutely. What's your typical length of holding an investment?
Sorry, really cannot see. Really cannot say. It depends. Sometimes short, sometimes long. Yeah.
This might be a good opportunity to ask the audience if you have any questions for our panel. I'll give a long pause here to allow you to stick your hand up. I'm sure there's something that someone wants to ask. Clive, you're looking. Okay, well, have a little think. I'll come back to you shortly. But let's talk a little bit about when are things going to get better? When's it going to change? We've talked, it's, we're talking about where we are in the cycle. What's going to make it different? The trade war, we should probably mention, actually. We haven't, I've got it in the list here, but we haven't mentioned it yet. Having some possible solutions on the horizon or not? What do we think? Who wants to come in on the trade? Or David?
Yeah. This is something we always debate in the groups. You're talking about the global trade war, right? Not the U.S. and China.
Well,
you mean
U.S. and China? Interesting that you said that, because people.
Okay. Yeah. So what I said is personal view. Okay. So
that's fine.
So we will say it definitely will negatively affect the demand of China, but not a lot. We view the base, the demand of China. The base is large enough, so, but it will affect it in the short term. But on the other hand, has to be developing. So anything trade tension or recession is just part of the development path towards the future. So again, if you can find a good opportunity in the low time, then I think you will be good in the long term. So that's what we view the trade war, because it's very hard for you to forecast any particular decline figure, whether it's 10%, 5%, or it's 15%, even higher or even lower. So that's we view the things,
And we're already seeing a lot of manufacturing moving from, for example, Guangzhou into
Yeah,
North Vietnam
yeah.
and places like that.
Yeah, but they cannot move the whole value chain. They might move some part of it, but not the whole value chain, I think. Yeah. Big times, I think. Yeah.
Greg, any thoughts on the trade war?
Well, look, I don't know how it's going to all turn out. I think logic would tell you that they'll reach some agreement that's in the best interest of everybody, but I'm not sure if we've necessarily got totally logical people running countries at the moment. But look, I think clearly it's had a big impact. It certainly slowed growth. It slowed people's confidence, or at least impacted people's confidence. So that's affected investment decisions. So just talking to people in the market, traders and that, they say, yeah, they've definitely seen a slowdown in demand for various commodities. So it's hurting the real economy, which is why I think, again, you've got a commodity like copper, which everyone, is very bullish on long term, and strategics are very actively trying to increase their exposure to it through acquisitions, but it's trading at, $2.50 per pound at the moment. So, look, I think until we get some resolution around trade, I think the market for certainly industrial minerals is going to be pretty challenged. Hopefully we'll get one. I do agree, though, with David's view, sort of longer term, sort of the underlying growth potential for the world is still very strong. That's going to be very positive long term for mineral demand. So I think long term, I think we're still have a very good demand picture. I think it's over the next year or two, it's going to be difficult. Are we going into a recession? I think as many people think, maybe more people think that we're really going to see a recession globally, or in various countries like the United States, versus continued growth. So if we see a recession, that's obviously going to be pretty negative. And until I think all of this uncertainty gets behind us, I think we're going to continue to see a weak environment for base metals.
But given that, as you said, the copper price is not that strong at the moment, but there is long-term shortage of supply, sort of lining ourselves up for a pretty strong upswing in a few years down the track, but it's just when, I guess.
Look, I would agree with that. And when the market gets into a squeeze, you can see what can happen. I remember back, I think it was 2004, 2005, copper suddenly went to $4 from it was traded at 60 cents for ages. So you can see a very explosive increase in the price, and some people will give you lots of reasons why you should expect $9,000 per ton copper. But I think we're going to need to see some greater clarity on the economic environment before we see a big improvement in prices.
So where should mining companies be looking to raise their money right now? Peter's obviously had some success with the EBRD, but who's going to be funding the junior sector in particular for the next couple of years until things come roaring back?
Sounds like the cannabis companies.
Yeah, I think in Canada and that really started happening last week, really last couple of weeks. People will start taking money out of cannabis, and then all of a sudden the narrative has become mining stocks. As I said, huge interest for silver. People sort of looking at nickel. So I think the retail market in Canada will somewhat come back, but I think it'll be slow. the other thing is, this gold price of 1,500 is a horrible price to get into. So a lot of people feel like it's tough to take the plunge because, for instance, it would be a terrible moment to buy a bar of gold, just based on the fact that it could easily be 1350 in a couple of weeks. Yes, it could go up a lot, but it's a very uncomfortable price. So I think the focus of investors is more on those small arbitrage opportunities. Like, for instance, silver typically lags to gold, so they'll go to silver. Or what you were saying, the mid-tiers and seniors are moving up, so looking for the developers and the juniors. The juniors and the developers the juniors have not moved at all. So that may be a safer place to put money, in those companies that the capital usually, if what I said earlier becomes true and companies deliver strong quarters for a couple more quarters and their stock moves up, that may give them the confidence to start investing in development projects or development companies. And then eventually that capital trickles down to the junior market. And also the retail market gets more confidence. Interestingly enough, talking about those alternative sources of capital, I think we're already at the point where people are not looking at that, because the junior miners in both Australia and in Perth and Vancouver are now in a situation where they can walk to the building in front to see the brokers and starting to get traction. So I think we're going to start seeing back the more traditional sources of capital. I think in the past few months, people were coming here to Asia, getting royalties, looking for really unconventional sources of capital. And then the last thing I'll say is that I think going to the trade war, in that environment, if things don't get fixed, gold should be doing better. But one interesting observation was how resilient gold was to the news that there was some progress. It pulled back a little bit, but it basically came back up. So I mean that tells you a lot. I'm not obviously qualified to comment about the trade war between the U.S. and China, but just that observation of the reaction that gold had to the announcement when Trump announced there was some progress in the talks. That really tells you a lot as to where people are at. And I think, in terms of the base metals, the only opportunity for them to have value appreciation is going to come from a lack of supply, which is definitely coming at some point.
You seem to be painting quite a reasonably positive picture of the retail space in Canada. You mentioned earlier that Eric Sprott was on the spree, and now you're saying that retail investors are getting back into the sector. Have we already, are we already witnessing the turn certainly in Canada?
I don't think so quite, because I think a lot of people also, talking about the cannabis, a lot of people lost. I mean, some of those stocks are down 80%. So you might pull out $20 out of the 100 you invested, and maybe you say, okay, I'll punt them on some mining stock to see if I can make my gains back. But it's not the same. I don't think it's going to be dollar for dollar. You might have a better sense.
No, I think that's right. Sorry, I think, there it is. The retail sector is coming back, and we are seeing the private placements start to get a foothold, but the generalist retail investor just coming into the market and buying junior mining stocks, we haven't really seen that yet. I would like to comment, though, on another area where I think we are starting to see some additional interest, and that's in the strategics, the majors and the mid-tier gold companies coming back into the space. There's a bit of a pause over the last 12 months or so, given the mergers, the giant mergers of Barrick, Randgold, and Newmont Goldcorp, where those acquisitive companies below that tier have sort of sat back and looked at what non-core assets might be sold off by those two new super gold companies. And we will see some of that over the next 12 months. We will see some non-core assets come out. But those companies do need to replace their assets. They will come back into the developers and the juniors, and they will make investments, and they will make acquisitions. We saw one not too long ago where St. Barbara out of Australia bought a Eastern Canadian company for $800 million. They paid almost $330 an ounce for those reserves. So I think we'll see more of that, and that's relative to a junior market or a developer market that's getting paid about $20 or $30 an ounce for reserves. So these companies do have to pay up, and we will see more of that over the next 12 months or so.
They bought that company on the eve of our Singapore conference, and the guys were there, and their company had been bought, and they just sort of sat there going, well, we'll take meetings, but really we don't care.
Maybe that'll be us next year.
They were pretty happy. I think we've got a question here. Clive, you got a microphone?
Clive Whittington. Thank you, panel. I think we all endorse your observations and concerns about the general economic outlook. But David touched upon one area, namely high technology metals. And in that space, I think, David, you're quite correct in identifying the battery metals, and particularly lithium, nickel, and cobalt, and why the lithium and cobalt prices are not looking good, and they're likely to stay there. Nickel has a lot of hope. So that on the one hand, we have an overall negative, and you've given us a great insight into gold, silver, etc. I wonder if the panel could give us a comment on this particular area of battery materials. And in the case of nickel and cobalt, I have never in my career seen growth rate like this. So while there's a lot of negative, this is the singular area where there is astronomical growth, up to 20% per annum. And there's a lot of opportunity. The other point is that to reinforce David's interest in this, is that the battery materials are not just base LME price, they're LME plus a very handsome premium. So I'd be interested, Leo, if you could invite the panel to comment on that general area with an emphasis on nickel, please.
Absolutely. John?
No, certainly I'd agree with that. Generally when we're looking at which commodities we want to invest in, we look at the long-term demand growth rates. And most commodities will have a GDP plus or minus 1% in terms of what we can expect for demand to grow over the next 10, 20 years. But when we look at EV commodities, that's GDP plus 10%. Some of the demand growth rates that we're looking for, as you said, nickel, cobalt, lithium, graphite, can be anywhere to 10 to 15% because it's a new mega trend that we haven't really seen before. So if I've got a choice between which commodities I want to invest in, I'm always going to pick something that's growing 3 or 4 times faster than other commodities. So I think you're right. It's a really good space to be invested in. We've seen with a few of these that maybe the hype and the investment got a little bit ahead of the demand growth, and we saw that with lithium. We saw that, I guess, a bit with cobalt and graphite, and they're going probably through some tough times where the demand has to catch up to supply, but it will happen. And some of these commodities have now come back where they're trading into the cost curve. So for us at APAC, we're looking very hard at these spaces, and I think over the next couple of years there'll be some really good investment opportunities. And then specifically on nickel, this has been one which looked like a very good medium-term investment. I think at the moment EV demand or EV battery demand from nickel is maybe only about 4% of global demand, but you really see that really gets to some sort of critical mass, I guess, in the next 5 years, and then really expands from there. I think some demand forecasts have battery demand maybe more than 20% of nickel demand by 2025, 2030. So that's an interesting one. And then you've obviously got this Indonesian ore export ban coming through in January 2020. It's taken a lot of people by surprise. You've seen the nickel price rally ahead of that. We think you might get a little bit of a pullback in the next few months. If you're an Indonesian ore exporter and you're going to get banned in about 3 months' time, but prices are good, you're going to get as much as you can out for the next few months. So there's going to be a lot of nickel units that come out, but I think the medium-term outlook still looks fantastic for nickel and a lot of those other EV battery materials.
I think Clive's question also touched upon the sort of the processing and what you're going to produce in the end. So this high-purity nickel sulfate getting a big premium to the LME price.
Absolutely, and for example, in nickel, if you're producing say an HPAL, You've got a high-pressure acid leach project. You might be producing a mixed sulfide or a mixed hydroxide. There's an LME metal price for nickel, and if you're producing one of these intermediate products, you might only be getting 70 to 80% of that LME nickel metal price. If you're producing a sulfate that goes directly into batteries, you might be getting a $1 to $4 a pound premium. So, yeah, can make a really big difference to your economics.
Great. We're actually running out of time, unfortunately. We've got 1 minute left on the clock. So if I could just go straight down the panel and say commodity to look at for the next 12 months. We'll come back in 12 months' time and see if you're right. John?
It's probably gold in the next 12 months and then probably nickel beyond that.
Fantastic. Greg?
Gold.
Jorge?
Yeah, I'll have to say gold and then particularly silver and, but all the precious metals, I think, will look really interesting.
PGMs as well?
Yeah, PGMs.
Fantastic.
Yeah.
Peter?
I'll have to go with gold, but follow it up with copper as a close second.
Gold and copper. And David?
Are you talking about the 12 months, right?
Yeah.
Okay, I would say uranium and yeah, that's the one. Yeah.
Uranium.
Yeah.
Nice little addition at the end there. Fantastic. If you want to know why uranium, please do grab David afterwards. We've unfortunately run out of time. That would be my next question. We've got some uranium companies presenting over the next 2 days, so be sure to listen in their presentation and talk to David about why he thinks it's the hottest commodity for the year ahead. But thank you very much for our panelists. Very interesting way to start the event today. So big round of applause. Thanks.